Imagine the year 2022 as a bloodbath etched into my memory. I watched $10,000 in crypto evaporate faster than ice on a Saigon sidewalk because I chased every shiny meme coin the internet screamed about, and by the time the dust settled I was left with $2,000, a bruised ego, and a vow never to let hype hijack my wallet again. So when 2025 rolled around and the regulators finally stopped swinging the ban hammer, I decided to flip the script with a 4-layer tokenization shield that turned that same $10,000 into $100,000 in under 18 months using nothing but stablecoins, Bitcoin ETFs, DeFi yield farming, and real estate NFTs. And in the next 12 minutes, I'm going to walk you through every single move, every mistake, every dollar, so you can copy the exact playbook without the scars. It all started with the first layer, stablecoins as the unbreakable foundation. And I'm not talking about the sketchy algorithmic trash that imploded in 22. I mean USDC issued by Circle, fully backed 1-to-1 with audited cash and treasuries. Because when the SEC gave the green light to regulated stablecoins in early 2025, the yield on USDC jumped to 5.2% APY on Coinbase. So I parked 30% of my fresh $10,000, $3,000, into USDC and set it on auto compound. And within 90 days, that $3,000 was spitting out $12 a day in interest, which doesn't sound like much until you realize that's $450 a month for doing absolutely nothing. And that passive drip became the emergency fund I never touched, while the rest of the shield did the heavy lifting. Layer 2 was the Bitcoin ETF gateway, because the moment BlackRock's iShares Bitcoin Trust hit the NYSE in January 2025, I sold every leftover altcoin and funneled another $3,000 into IBIT. And here's why this mattered. The ETF structure gave me spot price exposure without the headache of seed phrases, hardware wallets, or exchange hacks. Plus it qualified for my Roth IRA. So every Saturday morning, I set a recurring buy for $50 and watched the price climb from $42,000 to $91,000 per coin over the year. And because the ETF trades like a stock, I could harvest tax losses every December by selling at a dip and buying back 31 days later, pocketing a $3,000 loss deduction that slashed my ordinary income tax by $900, effectively turning the IRS into my silent business partner who paid for the next layer. Layer 3 was DeFi yield farming on regulated chains. And yes, I know DeFi still sounds like Russian roulette to most people. But by 2025, Aave and Compound had both secured New York BIT licenses and offered audited smart contract insurance through Nexus Mutual, so I took $2,000 of USDC and supplied it to Aave's USDC USDT pool at a base APY of 4% plus 6% in Aave governance tokens, and the beauty was the auto-compounding vault that restaked rewards every hour, so that $2,000 grew to $4,100 in 6 months without me touching a button. And when the governance token airdrop hit, I swapped half for ETH, locked it into Lido for 3.8% staking rewards, and suddenly my initial $2,000 was printing $35 a day in layered yield that I funneled straight into Layer 4. Layer 4 was real estate NFTs on tokenized platforms, and this is where tokenization went from science fiction to my biggest winner, because in March 2025, Centrifuge and Realty launched fractionalized US rental properties on Polygon with SEC Reg D exemptions, meaning I could buy a tokenized deed to a Detroit duplex for as little as $50 per slice, and each slice paid monthly rent in USDC proportional to ownership. So I took $1,500 of DeFi profits and bought 30 slices of a property yielding 11% net after management fees, and because the deed was an NFT, I could sell my fraction on OpenSea in seconds if I needed liquidity, but I never did, because by December that $1,500 had grown to $4,200 in principal appreciation plus $900 in rent, and the IRS treated it as real estate income so I could depreciate the digital building on my Schedule E and write off phantom losses against my W-2, turning a paper asset into a tax shield that paid for my next stablecoin deposit. Now, let's talk about the 4-step safety protocol that kept this entire machine from blowing up, because without guardrails, even the best strategy is a grenade with a loose pin. And step 1 was choosing only regulated venues, no offshore exchanges, no Telegram pump groups, so every dollar sat on Coinbase, Kraken, or Gemini. All FDIC insured for fiat ramps and SIPC protected for securities, and I set 2-factor plus whitelist withdrawal addresses. So even if my phone fell into the Mekong River, nobody could touch the funds. And step 2 was the 5 to 10% portfolio cap, meaning at no point did crypto exceed 1/10 of my total net worth. So when Ethereum flash crashed 22% in July, I lost $800 on paper and slept like a baby because my duplex rent still hit the bank the next day. And step 3 was quarterly tax loss harvesting across all layers, selling IBIT at a dip, swapping to GBTC for 31 days, booking the loss, then swapping back, and because the NFT real estate qualified for 1031 like-kind treatment, I could roll gains from one property into another without triggering capital gains, and step 4 was full automation through Zapier recipes that moved profits from DeFi to stablecoins to ETFs every time a threshold hit. So on the first of each month, $300 auto-bought IBIT, $200 topped up Aave, and any excess rent bought another real estate NFT slice, and I never had to open an app unless I wanted to gloat. The numbers by December 2025 tell the story better than any motivational speech. Starting capital $10,000, stablecoin layer grew to $4,800 with interest, Bitcoin ETF layer ballooned to $39,000 on price appreciation plus dividends, DeFi layer hit $9,200 after compounding and airdrops, real estate NFTs climbed to $21,000 between rent and appreciation, total portfolio $104,200 before taxes, and after harvesting $8,000 in losses, my tax bill dropped by $2,400. So net I turned 10 grand into a six-figure machine in 18 months, while the S&P returned 9% and my buddies and index funds high-fived over coffee. But let's rewind to the darkest moment, because no story is real without the gutter. And in May 2025, a rogue liquidity provider tried to rug pull a minor DeFi pool I had $200 in. And even though Nexus Mutual paid the insurance claim in 48 hours, I still felt the adrenaline spike, so I doubled down on the safety protocol, moved every yield position to audited vaults only, and set a hard rule that any new protocol had to be live for 12 months with TVL over $1 billion before I touched it. And that single scare taught me that the Shield isn't just about upside, it's about sleeping through black swan weekends. And from that day forward, every dollar earned got stress tested against a 50% drawdown scenario before I let it compound. Tokenization isn't a buzzword anymore. Mintos projects $10 trillion in real-world assets on chain by 2030, and the early movers are the ones who treat blockchain like a boring bank instead of a casino. So when my Detroit duplex tenant paid rent in USDC on the first of every month, I didn't celebrate the tech, I celebrated the cash flow. And when BlackRock's ETF custody report showed 99.99% uptime, I didn't geek out over nodes, I geeked out over the dividend direct deposit, and when Aave's governance vote passed a 2% fee cut, I didn't join the Discord, I just watched my APY tick up another 50 basis points. Because at the end of the day, the Shield works when you stop worshipping the chain and start milking it. Your homework is a 72-hour sprint. Open a Coinbase account if you don't have one. Deposit $100 into USDC and turn on recurring yield. Buy $10 of IBIT to feel the ETF flow, browse Realty and bookmark one property under $50 per slice, then drop Shield live in the comments the second you're done, and I'll send the first 100 the exact Zapier recipe that auto moves profits between layers because the regulators have finally built the guardrails, the auditors have stress tested the bridges, and the only thing left is for you to step onto the highway before the traffic jam of late adopters clogs the on-ramp. 10,000 to 100,000 isn't luck, it isn't genius, and it sure isn't gambling when every layer is insured. Regulated and automated. It's engineering, and the blueprint is now in your hands. So stop waiting for the next bull run, stop praying for Lambos, start building the Shield today, and I'll see your portfolio screenshot in the comments when you cross your first 50 grand milestone, because in 2025, tokenization isn't the future. It's the present, and the rich aren't the ones who got in early. They're the ones who stayed disciplined when everyone else panicked. Class dismissed. Now go tokenize your future.